But I think, kind of one thing that we're going to talk about that along with the challenges, there's really opportunities also. Does that make sense?
100%. I think it's the best time to be doing this. We've got a better story to tell than at any point in time in the last 30 months. So the opportunities are definitely out there.
Yeah, I agree. So, hey, I guess I'm supposed to do like an official intro of some sort or something. So I'm speaking with Owen Lee. He wears a couple hats. So the one hat that he wears is he's the CEO of the mortgage company that I hang my hat at and have for the last, how long we've been working together, Owen?
I think we're getting close to 10 years now, Carl.
Yeah, is it? Yeah, okay. Frankly, I thought it was a little longer than that actually. So no, in a good
It may
way.
be.
Yeah, in
It
a
may
good way.
be.
So
Yeah.
somewhere around there, 10 years or so.
Yeah.
And then you wear another hat, and I'm gonna screw up this other hat. So what's the official title?
So I will be in about 2 weeks sworn in as the vice chair of the National Mortgage Bankers Association, which is a 3-year commitment. So I'll be the vice chair in 2025, the chair elect in 2026, and then the chair in 2027.
Perfect. So
So,
uh
yeah.
so how's it feel that your whole adult life you finally worked yourself up to being a chair? It's just something about that. Ugh. No. Hey, so what we were
Right.
what we were talking about before we hit the record button is there's a lot of refinance there's a lot of refinance opportunities, and we're going to talk about that. And I think that the big so there's some good news and there's some, let's call it, challenging news. It's a little
Full of
disturbing.
challenges. Yep.
Yeah, a little
Hmm.
disturbing. But I really honestly believe that as long as we do things right, I honestly believe that we're in for a really good fourth quarter and a really
Hmm.
good first quarter. I think boy, the last 3 years have been tough.
Well, I 100% agree if you take the correct steps. So if you just kind of recapture a little bit what we were talking about earlier, obviously the 2020 and 2021 huge pandemic years. Everybody hates 2022, 2023, first 6 months of 2024. I hate them too. It wasn't fun, but we needed to have those. We needed to have
Mhm.
that time. We needed to recalibrate. I always think it's important to say this. We needed to recalibrate what the public's perception of a normal interest rate is, right? A normal interest rate doesn't begin with a two and it doesn't begin with a three. That only happens when the federal government's buying 80+% of all the mortgages out there, and that's not sustainable. But it was fun. But now after we have the run up, right, to 7 and 8, and the public's kind of recalibrated, we've been getting some weak economic numbers. The Federal Reserve's had a 50 basis point interest cut. They kind of said they're in their last policy statement, they're not worried about inflation as much as they are about the job market. And so we've got the lowest interest rates we've had for all practical purposes in at least 2 years. We've got a record number of homes on the market, largest since the beginning of the pandemic. Remember, 2 weeks to slow the spread, 15 days to slow the spread. Most houses on the market since 15 days to slow the spread, for those keeping score at home. We've got record home equity. We've got record consumer debt. All the ingredients are there. All the ingredients are there for a good run. So I agree with you. First quarter or fourth quarter of this year, first quarter of next year, and hopefully beyond that, absent some, economic news that nobody is predicting. We should have a good, relatively smooth run.
So that's the good news.
Hmm.
But there's a new challenge that, to my
There is.
knowledge, we've never seen before. So let's talk about that for a minute.
That's right. And this is and just so we're clear, because we don't want to. I'm only going to mention company names that have gone public with this. They've either done so on their earning call or something like that. So this is all public information. So basically what happens, if you just take a step back for a second, right? We're all in the mortgage business, but just to recapture, because I don't think a lot of people think this way, but when you close a mortgage, when a loan officer finds a borrower, they do the underwrite, they get to the closing table, they shake hands and high five. We remember what happens to that mortgage after, right? The mortgage gets sold. Even if it goes to a mid-level company or a bank, most of the time they get sold. And the actual mortgage itself, right, the investment of lending somebody $300,000 and then getting the payments, that goes into the mortgage-backed securities coupon that large companies buy, retirement funds, life insurance companies, sovereign governments, the whole nine. And then there's this other part, which is the mortgage servicing rights. And that is the job of collecting the mortgage payment. And that job pays anywhere from usually 25 to 40 basis points a year on the unpaid principal balance of the loan. And that job is collecting the payments. And so the mortgage servicing companies or the aggregators pay for that. And they really have had a change in attitude and a change of technology. It used to be that they spent a lot of time and energy trying to find loans that they thought the borrower was mathematically unlikely to refinance or to sell quickly. And they would pay a little bit more for those loans. Now they've switched, and this is really a new danger. So just to continue with the recap for 1 second, Carl. If a mortgage servicer keeps that client, that's called retention. That's really good for their economics and their bottom line. If they lose that client, meaning the serviced person, the borrower, gets a new loan from somebody else that's not the current servicer, that's called runoff. They call that runoff,
Okay.
Servicing runoff, and that's not good for them. And so the servicers have gotten much better at using technology, artificial intelligence, these different predictive technologies or propensity scores to determine who is likely to need a new mortgage, and they call the borrower first. And what we've seen is an increase in their retention by like 200, 250%. So just if you take like industry news, Mr. Cooper bought Flagstar's servicing portfolio. And when that deal closes, Mr. Cooper will be the largest United States primary servicer of mortgages, right? And in the second quarter, this is from their earnings call. Mr. Cooper's a publicly traded company. This is public information. They had a refinance recapture rate of 72.5%.
Now, so they refinanced their own mortgages at a rate of 72% of them.
That's correct.
What is, and then we collectively, us listen to this podcast, we got the other 28%, correct?
At least for that initial wave of refinances, yes.
Okay. So what is it? What did that you? So they got. Let's just say 70. They got 80%. Wait, what
Yep.
percent did you say again? I didn't write it down.
72.5. So
All right. So let's just
about 70.
So they got 70. We had the opportunity to do the other 30 collectively. Everybody listen to the podcast, give or take. So 70-30 in their favor. What was it 2 years ago?
30%.
So it's gone from 70 them, 30 us. No, it's gone from 70 us, 30 them. It has flip-flopped.
Flipped. Yeah.
So the 70% of refinances that we used to get, now they get, the servicers do.
Mm-hmm.
And now all of us collectively that's listening to this podcast today, we're not fighting over the 70%. We're fighting over the 30%. So it's like worst case scenario, it inverted.
Correct.
That's a
Yeah,
major
it's not.
challenge.
It's a huge win for the servicers.
Sure.
It's a huge win for really technology, right? Because they use technology to put themselves in front of borrowers who are likely to need a new mortgage. And it comes at the expense of independent loan officers, right? Whether you work in an independent mortgage bank, whether you work at a bank, whether you're a mortgage broker, it affects all of us. And so we really have to take a look at this and put a plan into place to be successful. There are some bright spots in this picture, but when you just look at the numbers, it's I know we were joking, Carl. We recently did a webinar where we had some slides of Freddy Krueger up there. For those of you listening to this podcast, I'm 54, so Freddy Krueger was my nightmare when I was 14, 15, 16 years old. Right, Nightmare on Elm. I did not live on Elm Street, but I certainly saw the movie franchise, and it's a scary picture. And for those of us that don't keep on top of our pipeline management, our contact management system, these refis are going out the door. We don't even know it. So you really have to stay on top of your game.
So the good news is there's twice as many refinance opportunities because of the decreasing rates and the increasing in equity.
Mm-hmm.
The bad news is we're going to be getting less than half of them because the servicers are very aggressively going after those for the first time. Why did I just why did it take why weren't they always doing this? Why weren't they always fighting for the to to refinance their own? Because my guess is like probably the other thing that's triggering this is like when I call when my borrower calls to ask for a payoff, and I'm not speaking of Mr.
Mm-hmm.
Cooper per se, but I'm using air quotes here.
Sure.
Mr. Cooper just got a request for a payoff. Well, Mr. Cooper is going to call the customer and saying, "Hey, you're already writing your check to us. We can make that keep happening."
Well, I think it's beyond the payoff request, right? That's kind of a common tale with loan officers, kind of figuring out, hey, tell your title insurance agency, tell your escrow company, don't call for the mortgage payoff until the day before closing because that's going to prompt a call from the servicer to the
Yeah.
borrower. It's way beyond that. They're using artificial intelligence, they're using predictive technologies and propensity scores, meaning they're tracking the people on the web, they're tracking the value of their home, they're tracking obviously where their mortgage insurance is, they're tracking their credit score. There are tools for all these things, right? My wife calls it creeping on some, they're creeping on your web traffic, and I understand that has a negative connotation, but this is a real thing now, right? We always joke inside of our office that Jeff Bezos sells somebody a 6-pack of toilet paper and he knows more about that client than we do, and we have their last 2 years' tax returns, right? Well, these large companies, data is available to them in the aggregate, but the technology has gotten so good at breaking that down and applying them to the client's individual scenarios that they're really contacting them well before the mortgage payoff is ordered. So 10, 15 years ago, that was the telltale sign. You ordered the payoff the day before the closing and it was too late, right? Game over. They're really using predictive technologies and propensity scores and different things like that to find and get in front of the borrowers early. Now, the good news is, and before I get to that, let me just give you one more example from an earnings call, right? Rocket Mortgage. I'm from Michigan. I'm actually a big fan of Dan Gilbert, a big fan of Rocket Mortgage. I think they've done a lot to propel the industry to a better place. So I say this with admiration. Varun Krishna, the CEO of Rocket, told analysts in their August earnings call, retaining clients for the next transaction at a rate 3 times higher than the industry average. So Rocket is using the same technologies to get back in front of their client. And Carl, as we've talked about many times, you know, Rocket is not necessarily the cheap company. They're the fast company. And so that's just another example, right? I could go through three or four more. They're all out there. All this is public record for financial nerdy people like me who look at some of that information that's available for the publicly traded companies. But the bright spot is this. The bright spot is we have technology and the ability to stay in front of our pipelines if we're having a relationship with the people in our contact management systems, within our sphere of influence, as we often talk about, is a great way to combat this, but you got to do it at a higher level. You got to bring your A game, right? And at least so far, these companies have really honed in on the refinances. So that 72.5% is a refinance number, right? So for those of us that are going after the realtors, going after the purchases, the competition in that arena is not yet at that fever pitch, but it's coming. It's coming there.
Mm. Yeah,
So,
because I was sitting here thinking, all right, well, what's the take home message here? And I had a couple of them, but you just shot one of them down at some level, I think. I hadn't thought about that because I was sitting here thinking, well, the good news is, it's not that we don't focus on refinances. We do focus on them in addition to
mm-hmm.
purchase, right? We focus on both, right? Because it's
Correct.
we don't just sell the front tires on a car, we sell the back tires too, right? So, to
Mm-hmm.
focus on all four tires. And so focus
And
on
in
the
this market, especially, we got to sell the cash out tires,
yeah,
right? So
that's exactly right.
this is
And so
arguably the best cash out refi market we've seen in years and years.
yeah, so because I was thinking, in the past during times like this, you see these refi shops pop in and
Mm-hmm.
do the best they can, and then they frankly go out of business at some level as soon as the boom ends. And so they're probably going to have less opportunity. And
Mm-hmm.
and for us to ignore the purchase side to go through that expense, looking to go after just the refi might be a big mistake. That again, let's spend some time on the refi. But
Yep.
I was thinking when you first started talking about this, I thought, well, I guess that's just more reason to focus even more on the purchase. Um, so
I
I think
think.
that's part of it. And then the second message I got is, I was just sitting here thinking, so I've got a dear friend of mine that owns a furniture shop.
Mm-hmm.
And brother, if I need furniture, guess where I'm going? I'm going to my buddy's shop.
Yeah, you
Right? I
go to
mean,
your friends.
yeah, of
Sure.
course. And he builds good furniture at a, fair enough price, right? And he's my buddy, right? He's my buddy.
Mm-hmm.
So I think what we really need to do is making sure that we're not putting all our eggs in the refi basket, that we're
Mm-hmm.
continuing to market for our purchase, and then B, um, making sure that my past database knows who Carl is and I'm not a stranger, and that at some level, and again, I'm using air quotes here, certainly not demonizing Mr. Cooper. Frankly, I think they're able to retain 70% of the refinances. Awesome, right? They're obviously doing
Correct.
something right, and we could learn from that
Well,
for sure.
and almost all the big ones are doing it right. This just
Yeah,
happens to be. I picked them because they're the biggest, and it was right there in their earnings call.
yeah. I get it. I get it. And again, my
Yeah.
hats off to them for doing a great job.
Mm-hmm.
But yeah, if I'm going to be competing against those people, um, I better have my game on as far as when I call my past database, they know who I am. I'm not a stranger. That I'm using this predictive technology that you're talking about, right?
Yep.
I'm using that so that I can see when opportunities are. I'm calling them, right? So
Mm-hmm.
we always
Mm-hmm.
call them like four times a year. We snail mail them once a month and we email them once a week. But you know, boy, you really got to be on your game on marketing to your database, because if you
Well,
call them on an ongoing basis and they go, who is this? Who are you? You're in for a really hard time.
Well, I think that's 100% true. And what you have to do is you have to think of yourself as being in a constant relationship with them, right?
Good word.
And
Good
that
word.
means you have to call them. I don't think there's any substitute. I know most people listen to this podcast, they don't watch it. I'm holding my cell phone in my right hand right now when I say we have to use this wonderful tool that Steve Jobs gave to us all, this phone that is never more than 6 inches away from our hip. Um, and we have to be in a relationship. You know, the national average of borrowers that go back to their previous loan officers, only 17%. So on average, we're only recapturing 1 in 5. And I would argue that this information from the servicer is going to drive that number down even further. And but if we're in front of them and we're using a technology that's predictive, or we're using a propensity score, or quite frankly, we're just calling them on a regular basis, um, then we have a much better chance to combat this. And I would argue that the people that are likely to listen to a podcast like this are more engaged with the business than the regular loan officer out there, that are better situated to have success. But you have got to do that prospecting, and you've got to do it on a regular basis. This is way beyond, you know, birthday emails and turkey recipes the day after Thanksgiving, right? That's no longer enough. You have to
Enough.
call and talk to the people. And I know a lot of times you call, you'll catch up with someone, you'll chat with them for 11 and 12 minutes. They don't need a mortgage. You get off the phone, you think that was an unsuccessful call. I would argue that that's a very successful call.
Yeah.
You're keeping yourself in front of that borrower. And you've got to infuse a little bit of technology in there too. You got to use all the resources that you have.
Yeah. Good stuff, man. Hey, so Owen joins us on the Loan Officer Breakfast Club every Thursday, and he
Mm-hmm.
brings industry knowledge. We talk about where rates are going. Couple Thursdays ago, we had the update on the trigger leads.
Yep.
We were some really good news on that. And to hear more about what Owen does, come join us on the Breakfast Club. It's free of charge. There's no charge for this. And we talk about market movements. We talk about marketing.
Mm-hmm.
We talk about industry news that we need to know. So it's a really good place. We do it 30 minutes every day, Monday through Friday, and on Thursday is Owen's Day. So come check us out. So it's loanofficerbreakfastclub.com, loanofficerbreakfastclub.com, and just tell us where to send the Zoom link, and you join on a Zoom link, and we average, I don't know, 500 to 700 people on there every day. And Thursday is one of our bigger days because of Owen bringing great information. So appreciate you being here, buddy.
Well, and Carl, you forgot the number one ingredient of those Thursdays, and that's fun. We also have a lot of fun.
We do it's educational fun, that's for sure.
That's
So
right.
good stuff, and it just starts
And some
everything on
energy.
a positive note. So we talk about challenges, but then we talk about how to overcome those challenges. So we're not going to bring up a problem we don't have a solution for. Is that we solve problems, and you've been a problem solver for a long time. So I love you, man.
Well,
You're a great guy to work with, and I appreciate everything you bring to the industry, my brother.
thank you so much. I love it, and I love the opportunity to chat with people and be a guest on your podcast.
Sounds good. All right, we got another episode coming up with Owen here in the next couple of weeks. So, but go check us out, loanofficerbreakfastclub.com, loanofficerbreakfastclub.com. Join the crowd. We'll see you there. Thanks again, everybody. Bye bye.